The New York Stock Exchange is, by far, the largest stock market in the world. It's been that way for many years. And since its founding under the Buttonwood Tree on Wall Street in 1792, there are a few truisms that have become apparent. Thanks to the work of Ed McQuarrie, whose historical return figures we'll be using in today's video, we have access to a near-complete historic record of the US stock market. And while return data from the very distant past should be taken with a grain of salt, it doesn't mean that there aren't valuable insights we can take from the general trends as investors going forward. With that being said, after poring over nearly 230 years worth of market data, here are some of the biggest lessons and takeaways I've found, as well as what we can do with them to get the most out of our investments. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. One of the overarching lessons that I've found in digging through this dataset is that even with an extra 100 or so years worth of returns to look at, it remains very clear that patience as an investor almost always pays off. This is largely because, assuming your investments are well diversified, the risk of losing money in the stock market tends to decline the longer you stay invested. Crashes, when they come, as they always do eventually, more often than not tend to be short-lived, and you only ever truly lose money on the investment if you sell, which makes the importance of taking precautionary measures like building and maintaining cash buffers and/or emergency funds clear. To put some actual numbers to these takeaways, let's dig into the actual history for a moment. Based on McQuarrie's dataset, in any given year, you have a roughly 26% chance of seeing your investments decline in value. So call it once every 4 years on average. About once every 10 years, you'll experience what I refer to as a noteworthy decline, or a down year where the value of your investments fall by at least 10%. And there have been just 7 years in which the markets have fallen by a crushing amount of at least 20%, or in other words, about 3% of the years in this sample. However, if you look at longer time spans, those numbers quickly start to look a lot better. Here's a chart depicting the likelihood of experiencing down years of different severities over different time spans. I should note that the returns I'm using here are not being adjusted for inflation, as while estimates exist, it's difficult to find a lot of inflation data going all the way back to the 1700s. But anyway, as you can see, the risk of a loss of principal declines pretty quickly as your time in the market grows. In fact, after just 5 years, the likelihood of experiencing a truly cataclysmic loss is basically gone. If you have a decade to let your investments sit, the risk of experiencing correction level losses when all is said and done is also more or less gone. And, at least based on this dataset, if you had let your investments sit in the market for at least 20 years, you would never have lost money on a nominal basis. Technically, the longest it would have taken for you to make money in the stock market based on this dataset was 17 years, which took place from 1826 to 1843, but you get the point. Historically speaking, the longer you stay invested, the better your chances are of making money. And that's pretty good to know given how well the stock market has done since its inception. In fact, if you had invested just $1 into the markets when this dataset began back in 1793, that $1 would be worth over $27.6 million today. Even if we adjusted that figure for inflation, or at least the best estimates for inflation that I could find, again, there isn't a whole lot of reliable data out there for the early part of this time period, that's still an inflation-adjusted net worth of something in the ballpark of $750. Now granted, if you were alive to be investing in 1793, you'd have died long before now, but still, that's pretty insane. Unfortunately though, not all periods in the market's history are good ones. Every now and then, it experiences crashes, and some of them have been breathtakingly brutal. Thankfully though, most of them are not. And they also tend to be fairly short-lived. Based on this dataset, which looks at the value of the markets once a year in January, the deepest stock market crash occurred during the Great Depression, when the markets lost over 70% of their value. We know from more granular datasets during this time period that the Dow actually cratered by roughly 90% by the summer of 1932, but again, this is a yearly dataset. The longest crash also came during the Depression, when the markets took a good decade and a half to fully recover from their steep losses. However, the vast majority of downturns never even got close to being that bad, or that long. The median depth of downturns was a mere 7.5%. And the median downturn duration was just 1.5 years, which is saying something since this dataset is based on yearly figures, so the absolute shortest a downturn could possibly be is 1 year. For those who are interested, here's a chart showing the depth and duration of the 10 worst downturns throughout the years, ranked by how far they fell. As I said, they can be pretty brutal. on 8 different occasions, the markets dropped 20% or more from prior highs. The thing to remember is that you only actually lose money if you choose, or are forced, to sell your investments. So especially during more turbulent market environments, it may not be the worst idea in the world to take a step away so that the constant stories of doom and gloom don't tempt you into making decisions that you'll later regret. What this chart also illustrates is the importance of taking precautionary measures and having our financial house in order before jumping whole hog into the investing world. Obviously, as we just went over, typically crashes don't last much more than a few years. However, occasionally they do. And on those occasions when they do, it tends to be because the downturn is pretty severe. As the old saying goes, the markets can stay irrational longer than you can stay solvent. So, it's important to ensure that we have our bases covered if something should happen to us, like losing a job or incurring some major unexpected expense. That way, we aren't forced to sell our investments when they're down, because major setbacks like this can take months or even years to recover from, as we've explored previously on this channel. Another overarching lesson I've taken from this dataset relates to the importance of diversification. If you were to ask people to make a prediction about the future of investing in the stock market, you may get a lot of different answers. Depending on the time you ask the person, and what the general mood is surrounding the markets at that time, they may answer that the markets are about to experience a correction or crash, or that the markets might as well be on a rocket to the moon. But if you try and take the emotions of the current moment out of it, as best as you can anyway, and think about the long-term future of the markets, one thing that often comes up is that, over the long run, stocks are almost always guaranteed to increase in value. And as we just saw, at least for the US stock market, that has been the case so far. We don't know for sure if it'll be that way forevermore, but there's obviously a good amount of historic precedent for it. Another thing that might come up is that stocks will almost always be a better long-term investment than bonds. And that may not actually be as airtight as it would seem based on recent history. Historically, more often than not, stocks have outperformed bonds, but it wasn't always the case. Here is a century-by-century breakdown of the number of years stocks outperformed bonds. As you can see, the majority of the time, stocks have won out. But particularly in the decades prior to the 1900s, it looked like it was almost a coin flip. The reason behind this is unclear. Perhaps it was because the markets were much newer, smaller, and less popular to invest in then than they are now. Perhaps it has something to do with inflation during much of those years. I mean, today we take inflation as a given, but prior to the early 1900s, that wasn't actually always the case. In fact, according to estimates from Dr. Robert Sarr of Oregon State University, between 1793 and 1900, the dollar actually experienced deflation of roughly 0.15% per year on average. That would mean that money could buy you roughly 15% more in the year 1900 than it could in 1793, which would be an unheard of fate for the value of money over time in the modern day. And since bonds tend to do a little bit better in deflationary environments, that could help to explain the relative parity of the two asset classes during much of that era. Perhaps, like most things, it's a combination of factors. Regardless, it is worth noting that, for over a century, stocks were not the surefire, superior growth choice that they've often seemed to be for most of our lifetimes. Whether we'll see that in the future is, of course, anyone's guess. But even if we don't, there may be some valid reasons to add some bonds to your investing portfolio. As we know, stocks and bonds have historically not been very correlated with each other. When stocks are up, bonds are often down, or at least not up by as much, and vice versa. So, if you regularly rebalance your portfolio, you're essentially forcing yourself to sell some of your investments when they're high and use those funds from the sale to buy some other assets when they're low, which can do wonders for stabilizing your wealth building journey. And that can be vitally important for those of us who are a little bit more anxious with our investments, or those who are getting close to needing to start withdrawing from their nest egg. Because obviously at that point in our financial journey, 1 or 2 rough years in the markets could throw our plans out the window. And historically speaking, there doesn't seem to be a very big price to pay to get those benefits in that sort of situation. Here's a chart showing the average rolling 40-year annual returns for a 100% stock portfolio and a 50% stock, 50% bond portfolio. Obviously, the all-stock approach has higher returns, but not by a crazy amount. However, it does have more volatility and deeper crashes, which can make a difference especially as your investing time horizon begins to draw to a close. What's also interesting is how slow of a start the markets got off to when compared with what they've managed to deliver in more recent decades. Here's a chart showing the average returns of the stock market by decade. You'll notice that prior to the 1860s, stocks struggled relative to the returns they produced for many of the following decades. Again, I can't say for sure why that was, but it is interesting to look back on now. So those are some lessons and insights over the last 230 years of stock market returns. I know that's not really anything we haven't already heard before, but in a way, I actually find that worth sharing. Because even though after doing these videos for the last 5 years, and looking back at stock market history from the past century, I already kind of assumed that this would be the case, it is still nice to be able to actually dig into the data and get that confirmation. And what's really cool is this information is available to everyone for free. So if you want to check it out for yourself, I encourage you to take a look at Ed McQuarrie's latest studies, which I'll leave links to in the description below this video, and I'll also leave a link to an interview he did with Meb Faber for those who want to hear more about the how and why he put this data together. If you do decide to check out the data for yourself, let me know what some of your takeaways were. I'd be really interested to hear what you guys think. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.